As of 10:09 a.m. Eastern Time, Lithium Americas, ticker LAC, is trading at $4.59.50, up just about 1% on the session. It's been trying to find its footing after opening lower, trading in a range between 440 and 472 so far today on about 3 million shares. Now, the expectation for a stock like this is pretty simple. Lithium is the future. EVs are the future, and LAC, with its massive Thacker Pass project in Nevada, is a golden ticket to that future, backed by General Motors and the U.S. government. Many see it as a ground floor opportunity, the next Tesla stock, but for the raw materials that power it. The reality, however, is what we're seeing in the charts and in the fine print. The reality is that just yesterday, JPMorgan upgraded the stock, not because the future got brighter, but because the stock had been sold off so significantly that it finally looked fairly valued at $5. The reality is that this company, despite its government loan, just filed for a $250 million at-the-market equity program. That means they can and will be selling new shares into the open market. And that's a reality that every single investor, whether they're using the Robinhood app or a sophisticated interactive broker's trading platform, needs to understand. This creates an immediate tension. The market narrative is about explosive growth and a secure domestic supply chain. The trading reality is about cash burn, dilution, and a project timeline that stretches out for years. This isn't a stock you just buy and forget about in a Schwab Intelligent Portfolios account. This is an active, high-stakes speculation on future execution. The trading action of the last several weeks tells this story perfectly. We saw that parabolic spike, a rally of over 200% when the U.S. government's loan and equity stake were confirmed. That was the expectation trade. That was the thematic, retail-driven excitement, with people piling in through their SoFi Invest accounts, chasing the headlines. And then gravity reasserted itself. Analysts at firms like BMO and Cowen stepped back and pointed out that this valuation had gotten way ahead of itself. The stock pulled back hard, and what we're left with is this nervous stabilization, a battle between the long-term dream and the short-term financing needs. Let's look at what's really driving the price today. It's not just the price of lithium, which itself is in a tough spot. After peaking in 2022, lithium carbonate prices have been under immense pressure. We're in a period of oversupply. Inventories are high. So while everyone is focused on 2030 demand, the prices LAC might get in 2028 or 2029 are completely unknown. This isn't like Apple stock where you can count on iPhone sales next quarter. This is a bet on a commodity price 3 years from now. This macro pressure is weighing on the entire sector, and LAC is not immune. The volume we're seeing, while decent for this early in the session, is a fraction of the massive 20 million-plus share days we saw during the peak of the rally. This suggests the speculative fever has broken, and now the institutions are trying to figure out what this is actually worth. Is it a core holding for Fidelity Wealth Management? Absolutely not. Is it a speculative position in an individual brokerage account at Fidelity? Perhaps, but it's one that requires constant attention. The data on institutional ownership is fascinating. We know General Motors is a massive holder, which is a huge vote of confidence. But if you look beyond that, you see a lot of funds like the Van Eck ETFs, but also a constant shuffling. This isn't the stable buy and hold ownership you see in NVIDIA stock. It's a revolving door of funds trying to trade the momentum, which should tell you everything about the risk profile. So what does Lithium Americas actually do? Right now, it's a construction company. It is not a mining company. It is building the Thacker Pass project, one of the largest known lithium resources in the world, right in Nevada. The goal is to mine the lithium-bearing clay and, crucially, process it into battery-quality lithium carbonate right on site. This is what attracted General Motors, which has an offtake agreement for 100% of the production from Phase 1. It's what attracted the Department of Energy, which provided a massive conditional loan of over $2 billion to help build this domestic supply chain. The company officially separated from its Argentine assets, which now trade under a different ticker, to become this pure-play U.S. strategic asset. This was all part of the expectation bull case. But the reality is that Phase 1 isn't slated for mechanical completion until late 2027, with first production not expected until 2028. That is a long, long time in the market. 3 years of construction, 3 years of capital burn, 3 years of exposure to fluctuating lithium prices, and potential construction delays. This is the part that many online investing sites don't put in the headline. The $250 million ATM equity offering is the first dose of that reality. They need cash to bridge the gap and fund their share of the capital expenditures. This is a classic move for a development stage miner, but it stings for investors who bought at the peak, only to now face dilution. This is why this stock is so divisive. On one hand, you have the bull case, a strategically vital U.S. asset, a huge partner in GM, and backing from the federal government. It's a key piece in America's plan to reduce reliance on foreign supply chains. For those looking for investment help on building a long-term, high-growth portfolio, LAC looks like a textbook example. On the other hand, the bear case is just as compelling. The project uses a novel clay-based extraction method that hasn't been proven at this commercial scale. The commodity price is in a glut, and the company is funded by massive debt and now ongoing equity dilution. For someone who prefers self-investing in stable, cash-flowing businesses or simple Fidelity ETFs, this stock is a nightmare. It's a binary bet. It will either be a grand slam or a painful strikeout. There is very little middle ground. You can't just put this in an intelligent portfolio and expect a smooth ride. This is the kind of stock you watch daily on your Fidelity mobile app or your Robinhood feed, because news on construction, financing, or a court ruling could swing at 20% in either direction. So let's talk about the future outlook, framing it in this expectation versus reality model. The market expects that construction will proceed on time and on budget, that the DOE loan will cover the majority of the cost, and that by 2028, EV demand will have soaked up all the excess lithium supply, sending prices soaring. In this scenario, LAC is easily a $15 or $20 stock, a massive win for everyone who held on. The reality scenario is much more complex. The first risk is execution. Construction on a project this massive, using new technology, is rarely on time or on budget. Any delays mean more capital burn. The second risk is financing. That $250 million ATM is just the start. What if costs run higher? They will have to sell more shares or take on more debt. This is why Fidelity Brokerage and other platforms provide advanced charting tools so you can track the cash burn against the available credit. The third, and perhaps biggest risk, is the lithium price. If the glut persists, if new, cheaper supply from Australia or South America keeps flooding the market, the economics of Thacker Pass in 2028 could look very different. The project's profitability is entirely dependent on a price that is, today, weak. This is a stock for active traders who understand the risks, people using platforms like SoFi or Interactive Brokers who are not just buying a story, but trading the volatility. This is not for a set-it-and-forget-it Fidelity IRA account. The catalysts are clear: positive construction updates, securing final financing tranches, and any sign of a sustained recovery in lithium prices. The risks are just as clear: construction delays, cost overruns, further dilution, and a continued bear market for lithium. I want to know what you all think. Comment below with your honest take. Do you believe Thacker Pass will start production on schedule in 2028? Or are delays inevitable? Let me know your thoughts. To wrap this up, the story of Lithium Americas is the ultimate battle between a compelling, almost patriotic expectation and a very harsh, capital-intensive reality. The market wants to believe in the dream of a secure U.S. lithium supply chain, and it has priced in a lot of that dream already. But the stock's recent crash and today's nervous, low-volume trading show that reality is biting. The reality is that this is a multi-year construction project, not a producing mine. The reality is that they need cash, and shareholders will be the ones providing it through dilution. And the reality is that the underlying commodity is in a weak market. The upgrade from JPMorgan wasn't a buy the dream call, it was a stop selling the nightmare call, a purely valuation-based signal that the sell-off had gone too far too fast. The real value here won't be determined by excavators, by chemical engineers, and by the company's ability to manage its balance sheet over the next 3 very long years. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor.